go over to Phil, because Phil is investing in these properties, and Phil, Andrew just talked about, the construction side of it is not being affected as much, and you're a part of that construction side of it as well.
Yeah, absolutely.
So talk about the, possible recession, the dip and recovery time that you're seeing, in that opportunity gap, I guess, where you could try to jump in.
Okay, so one of the things that we've seen that's actually been, if there are other developers, they could actually be in a tough spot, is that nobody's really doing construction loans. People just sort of jumped from wanting to put money in there to just sort of jumping on the sidelines. Because again, if you're a construction lender, your bet is that they put a permanent mortgage on it and pay you back plus the bank, and right now there's so much uncertainty. So they're just sitting there waiting. Now, again, we bring capital from Denmark where there's negative interest rates. So we're better positioned to sort of handle that. And on top of that, it's, that we have a different type of access to capital. But in terms of how the construction will work, and we were down for a little bit, then it became a thing where we had to have less people on site working. We couldn't have 10 people, so it was 4 or 5. So things were moving a little slower. Then we had a few weeks where we couldn't do anything. Then it came back to we could have a few people. Now it's just ramping up and just going, it's just moving forward. There was just ways to just figure out how to get around those limitations. So from that standpoint, it slowed a little bit, but not anything that was that slowed us down in terms of when we were going to deliver these units to the market. But in terms of the lending and actually capitalizing these things, that has been difficult for a lot of people from what I've heard, because that capital is sitting on the sideline. I actually find it interesting what Andrew said, that the LPs have to meet their capital calls. And I'm kind of curious about that, Andrew, if you don't mind me asking, is this not a circumstance where, because in every contract, I forget what the actual legal term is, but what it say, basically the world going under clause, is that not something they can point to?
No, it's not a venture thing. So in venture, I can tell you this offline, or Charlie, you tell me if this is way off topic, but the short version is no, we're not tied to any one particular investment, so there's no act of God clause. We're in for like a 10-year plus cycle, and that's over and over. So no, there's no can I have a do-over option in VC.
Right, because in the real estate space, if people can even deals with people have had in New York, a lot of people they had deals under contract, and they use this as an out why they could back out of a certain deal, because they may not have the financing, the bankers back out. If they back out, you have to back out too, because you can't close the deal. So, but from that standpoint,
I live in a weird world. I mean, I meant it from the beginning. It's different.
Yes, absolutely. So it's created from that standpoint of construction. I don't know if you can say that has created any opportunity at all, because it's really slowed down. Yeah. And the capital that will bankroll the construction has sort of set aside. But what that really does is it just creates that surplus of opportunities where people say, you know what, let me liquidate and go elsewhere. Yeah. And then there's the reptile.
You're absolutely right, by the way. Like, there's a big difference between projects already underway and ones that weren't funded. The ones that are underway are ahead of schedule in a lot of ways.
Yes. So, yes, those are my thoughts, Charlie.
No, it's good. It's all good. And I think you're talking about an act of force majeure, act of God. But Drew, going over to you, I mean, what are you seeing in possible recession? If I'm investing in a particular property and I have some cash, maybe I want to start putting it into Lex and investing into the actual physical space. But I mean, what are you seeing from your, customers and the market?
So there's actually been a large push, both actually on the retail and then also on the private banking and institutional side, where they're looking for direct access to individual deals, which they usually do not have access to. So we've sort of seen the client base actually pushing sort of major financial institutions in the right direction. I know we saw a whole bunch of, when this was initially happening, we saw people trying to spin up hospitality debt funds, since they were like, oh, we're going to have hundreds of hotels going under so we can get them for pennies on the dollar. But I think that was not, I think it was misguided for the most part. Yes, there will be opportunities, but the opportunities that are going to be available, we won't see them really for 3 to 6 to 9 to 12 to 18 months. And so it's a much longer process. You have to remember, it really takes, unless it's an immediate transaction, all cash, in an extreme circumstance, the deals still take 3 to 4 months to close. So I still think we have a lot more coming. And really, when you're going into an investment, you really have to look at the tenant base, how long the leases are, what the credit ratings are, and sort of what the macro economy is in those different locations. Since I think New York, specifically is also impacted differently than the Southeast and also other areas. So it really is a case-by-case basis.
How about the future of real estate investing, right? And I guess we could stick with you, Drew. I mean, do you see a change in the process and the deal flow and what you're kind of looking at, and the, you know, the check marks you have to kind of go through to make the actual investment?
Yeah. So, I mean, our main goal was to make it so you don't have to be the 0.01% where you have to put in multi-million-dollar slugs into individual assets, really through two methods if it's direct real estate investing. One is through direct syndication, and the other is private equity funds. Yes, you do have public and private REITs. Private REITs also do have certain thresholds that you also have to meet, but there will be a lot more direct access to the entire financial sort of spectrum and give people more choice and the ability to actually sort of, as Phil was saying, create wealth for themselves. And it's not just for a select group of individuals, and at the same time have infinitely more transparency in data and open up an industry that has been known to be very slow, sometimes ripe with fraud and some bad actors, and those will be weeded out.
Phil, you got called out. Why don't we move over to you? We're talking about, you know, changing the investment process and the deal flow. What are you seeing?
What do I see? I mean, I think the way the systems will work, I think it will pretty much remain the same, because the ones who dominate the deal flow is the strong capital. For instance, Blackstone, and throughout, and I know this from reading the founder's book, that he always keeps himself well positioned. And obviously, they have $570 billion in assets under management, but keep himself well positioned to weather any storm. So, and you'll see a lot of the large private equity funds and the large endowments still control the majority of the deal flow. And so I see that sort of remaining a stable, a constant for the foreseeable future. However, something, just to throw it out there, like a Fundrise or Realty Mogul, something where micro investors, when I say micro, basically anything that's less than 10K, or anything that's with a credit, which is a small accredited investor check, anything really under 100,000, but 10K and below, I think you'll start to see a lot more than that, sort of like how you went into the public equity markets. And we've seen personally a lot of investor interest. I hadn't even promoted, and there's been a lot of people that have come in and bought shares. I think you'll see a lot more of that. Obviously, you're not able to scale with micro. You need the large checks to do that. But I think from an investor standpoint, you'll see more people who didn't invest before come and invest. But in terms of the big money that really still moves the needle, I think some of those things will remain the same. I don't really see how a GP-LP model can be disrupted. You saw some realty shares and some of these other crowdfunding platforms that raised a boatload of venture capital, and then they got to the Series A, Series B stage, and Series C even, where they started to run out of money, and the business model that they have and the lack of profitability. The deals didn't mature and show that exit that they needed in order to cover the losses that they've driven, and then they just had to liquidate their portfolios. I mean, you see a number. There's one called Prodigy Network. Realty shares is one example. So they tried to disrupt the fundamental model of how big money makes moves. I don't think that's really going to change. Deal flow, I think, for a lot of below the institutional investors, but above the mom and pop, sort of this large gray area where people even like us at this current time operate. There's going to be a lot of deal movement, I see, but the strong money that sort of controls everything is pretty much going to remain constant from my perspective. I mean, but it's just my opinion. So.